Good morning. Hope everyone's doing well.
Good morning.
Morning.
Any questions before we get started?
The quiz is due this weekend, right?
Yeah, so I've posted the quiz in the quiz folder. So I gave you till Monday at 11, so you've got plenty of time. Just 20 questions from chapters 3 and 4. So hopefully it's very familiar to you. So I don't expect people to have too much of a problem with it. Okay, so let's continue our conversation around, I think it's chapter 6. Just give me 1 minute. Okay, I'm back. Sorry about that. So we're in week 4. I think we've covered everything in chapter 5. And I'll try to finish up chapter 6 today, but if not, we'll continue it when we meet next, which is next Wednesday, because Monday is a holiday. So chapter 6 deals with the issue of audit responsibilities and objectives. And we started into this topic on Wednesday. So, and we talked about the main objective is to provide financial statement users with an opinion by auditors on whether statements are presented fairly in all material respects in accordance with applicable accounting framework. So when it comes to financial statements, we're going to talk about in compliance with U.S. generally accepted accounting principles. Excuse me. When we talk about, if we have to talk about the internal controls, we're going to talk about in compliance with Sarbanes-Oxley. We talked a little bit about the steps to develop an audit objective. So we have to understand why we're there, right? Which is, I think, pretty straightforward. We want to divide things up into manageable cycles. Understand what management's assertions are. You know, the more general and specific objectives for each of the classes of transactions, and we're going to look at that as we go through the semester, and so look, and then so forth. So, and then talked about management's responsibility. This is, I think, where we kind of left off, but for the financial statements and internal control and internal controls, and recognized that Sarbanes-Oxley, which was implemented in the early 2000s, really increases management's responsibility. In particular, the CEO and CFO certify quarterly and annual financial statements. Okay, went through this example of a report that management has to sign. And also understand that there's criminal liabilities for anyone who knowingly and falsely certifies those statements. So, okay, so I think we're on to part 3 now. So I'm going to open up the Kahoot to kind of intertwine questions with the slides. So. Okay, so we talk about management's responsibilities, both for the financial statements and for internal control. So let's just be clear that management's responsible for both of those things, not the internal audit staff, not lower level management, not the accounting department. The senior management's responsible for them. And the CPA or the auditor's responsibility is to attest that management has complied with generally accepted accounting principles and there are no material misstatements. And as we mentioned, Sarbanes-Oxley has put more responsibility on the shoulders of management. And that really came about at the insistence of investors and creditors who felt like that management had to have more skin in the game. So part of that is the certification of the financial statements and, if need be, the internal control processes. So we looked at this on Wednesday, what management signed for. So this it was a brief statement, but this is standard protocol now. There's also criminal penalties now, which had never been the case for anyone who knowingly falsifies these statements. And we know the difference between mistaken and knowing, right? Mistake is negligence, can be gross negligence, which you might be held criminally liable for, but intentional is fraud, right? And so fraud typically criminal penalties apply to fraudulent cases. So let's look at part 3, explain the auditor's responsibility for discovering material misstatements due to fraud or error, and the need to maintain professional skepticism when conducting the audit. The auditor's best defense when material misstatements are not uncovered is to have conducted the audit Yeah. Okay. So the best defense is that I followed the professional standards, right? So when you think about negligence, the thing that always comes up is, did you act as a reasonably prudent person would be? So in this case, a reasonably prudent person, if you're doing a professional audit, is somebody who knows what the professional standards are. And so if you're following the professional standards and there's a misstatement, then it's a strong point in your defense, right? But if you've neglected some of them, or you've missed some, or you've didn't pay attention to them, then that's where the issue of negligence comes in. But let's say you followed all of the protocols that you were supposed to as a professional, and there's still a material misstatement, then then you've got a pretty good argument to make. Which of the following statement is the most correct regarding errors and fraud? Yeah, an error is unintentional, whereas fraud is intentional. That's the distinction. And we know that we can also segment unintentional errors or negligence into two categories, which is ordinary negligence and gross negligence. So they're not treated the same, but nevertheless, negligence is certainly a lower level of doing something wrong than fraud is. When you do things intentionally, then you're really opening up the Pandora's box for the potential, not only for civil liabilities, but for criminal liabilities. So, and it can be tempting sometimes to, particularly when you're if you're part of a management team, to cross that boundary. And when I talk about tempting, I mean financially incentive. So So we just need to be wary and be aware that, of the penalties. The auditor has responsibility to obtain reasonable assurance that misstatements are not material, are detected. Yeah, so this might have been a little bit tricky the way I worded this, but the auditor has responsibility for reasonable assurance that material things are detected, but we couldn't possibly detect everything. So if something's not material, it's not that we don't want to detect it, but we don't have a responsibility to detect it, right? So we want to focus in on the big picture. If you think about an audit, we're really just doing sampling, right? So when we start to talk about the audit process in more detail, the term statistically, valid statistical sampling is going to come up as a means for us to test things. And so when we talk about valid statistical sampling, we always know that there's some error that's possible. But what we want, if you think about statistical sampling, the more significant something is, the higher degree of confidence we want for that particular item. So if we're looking at something that is not as material or significant, then we might lower the threshold in terms of statistical significance. But if we're looking at something that's critical to the perception of outsiders, investors and creditors, then we really have to investigate that much more thoroughly. But even with that said, errors can happen because the fact is, when we use statistical sampling, it's a sample of a population, and we hope that population represents the entire universe. But there's always some possibility of error, and that's just this is just one of the risks. This is one of the audit risks that exists. So, and sometimes you just get the unlucky draw, and you didn't find something that exists in the entire universe. But if you've used valid statistical methods and followed generally accepted accounting standards, then you're in good you're on good footing, and you have a very strong defense. So. Fraudulent financial reporting is most likely to be committed by whom? Yeah, so the data is pretty clear that when you talk about fraudulent financial reporting, much more likely to be committed by management. Anybody want to speculate as to why management's more likely than say company auditors or company employees?
Because they're the ones that make the financial statements.
Okay, yeah, so they're the ones who have access, right? So when you think about the triangle of fraud, one is opportunity. So senior management has access to the financial statements and can ultimately cook the books if they choose to. And it's much more difficult. It's not impossible, but much more difficult for an employee or an auditor to be in that position, and very unlikely that somebody on the board of directors would be able to. But we certainly is some possibility in all cases here. The concept of reasonable assurance indicates the auditor is what? Yeah, so when you think about reasonable assurance, I think, keep in mind, we're not guaranteeing correctness. What we're really saying is that I'm reasonably assured, right? What's my level of confidence? I don't know, pick a number. I even speculate, but I'm reasonably assured means 90, 95% confident that there's no problems here, right? And certainly, when you think about large multinational corporations and the complexities and the breadth and the scope of those, doing an audit is a monumental task. And what's your level of confidence? It's probably reasonable, but certainly not nowhere near 100%. If I'm doing a small entity that's very confined, one location, relatively small financial records and so forth, then my level of confidence can be much higher in my assertions. But people have to put things in context, right? So we're not paying for guarantees, right? Because if you wanted me to guarantee things, I'd have to almost go through every transaction, and that would be extremely expensive. We'd have to have armies of people in there, and we'd have to spend vast amounts of money to be able to do that. So it's the trade-off, right? That we have trained professionals who keep up with their professional responsibilities of being competent, follow accepted auditing practices, use professional statistical sampling methods, and from that we recognize that things can still happen, right? That we can draw a statistically valid sample that is outside of the overall it does not represent the entire universe. So those things, those risks exist, and that's why we say we can't guarantee it, right? But we have reasonable assurance, and that's the best you can do, best you can hope for. Audit is responsible for making sure that all of management's assertions are absolutely correct. Yeah, so here's another thing about reasonably assured versus guaranteeing, right? It's not possible for me to validate everything that management says about everything, but that does not let me off the hook by saying, well, it was management's opinion and I did nothing, right? So that's where the auditing standards come in. That's where the professional judgment comes in, that we have to do our due diligence. We have to act in a professional manner, do an audit in a professional manner, and make it, and so we can have a reasonable basis for our assertion that management statements are represent the results of the company. An item is considered material if it would have influenced the decision of a reasonable person using the statements. Okay, good. Yeah. So the question might become, what's a reasonable person using the statements? So it's not a reasonable person off the street, right? So it's a reasonable person who has a basic understanding of or more of financial statements, right? So so when we talk about what a reasonable person is, it really varies depending on the situation. But when it comes to financial statements, there's, if somebody has no background and has no understanding of financial statements, they're not what we're doing the statements for. We're doing them for somebody who has some understanding of how financial statements are constructed, what generally accepted accounting principles are. They don't have to be experts on it, but they have to at least understand things in the proper context. So, and that's what that's who we want to aim our materiality standard towards, right? So materiality, so this perfectly defines it. If it might influence somebody's decision, or if it would influence somebody's decision, then it's material, right? So that means that kind of gives us a little bit of leeway in terms of not having to worry about things that may be not correct, but if they're not material, then we can kind of not spend our time on them, right? We want to focus in on the things that are really material. So, you know, if you go in and audit a jewelry store, for example, and they have some very expensive jewelry, let's say, and then they have some stuff that is not very expensive, right? So you'd spend your time making sure that the inventory was valid where the high dollars are, not that not in every not on everything, right? And so that, okay. If there's collusion among management, the chances of normal audit would uncover such acts as what? Yeah, so collusion, where two or more people are acting together, makes it really difficult for to capture that in a normal audit. So keep in mind that when we're auditing, we're not looking for criminal activity. We're looking for compliance with generally accepted accounting principles and any material misstatement. So not that it's easy, but it has been done many times. And I'm sure it continues to be done where management figures out that if they can work with the right people, that they can get away with inappropriate activities, inappropriate booking of entries, selling off of things that belong to the company, and so forth and so on. So the expectation on the part of the audit team is that that if something is if there's a material misstatement that falls within the audit scope, then we certainly should find that. But collusion on the part of senior management is not something that auditors as a standard protocol are hired to find. So, you know, that's why going back to the scope, right? What's the scope of my audit? My scope of my audit typically is to find any material misstatements and compliance with GAAP. It's not to find collusion in the organization. If you want to hire somebody to find collusion, that's a whole different investigation. Probably not a CPA, probably somebody that has a law enforcement background. So it's not zero, but typically it's not found in the audit process. For illegal acts, the obligation is generally to notify parties within the client's organization. Yeah, so let's just unpack this a little bit though, because this is probably a little bit of an oversimplification. So if you're doing an audit and you find that somebody in the accounting department has been stealing some money or borrowing some inventory, whatever, then it's not the CPA's role to go to the law enforcement authorities. You should report that to senior management, and they'll make a call as to what the appropriate action is. Whether they go to law enforcement or not is not on your shoulders. So many times they'll just want to get rid of the person and not make a public fuss out of it. But as long as you've documented it, and you might even want to talk to an attorney about it, but as long as you've documented and communicated to management, you've pretty much done your job. Now, let me pose a slightly different thing. Let's say that you find that senior management or the board of directors involved in illegal activity. That becomes a little more challenging, right? Because who are you going to report it to, right? So if you're finding senior management or people at the top are involved in illegal activity, then I would recommend that you talk to an attorney at that point. And the likelihood is that you probably will have some obligation to report that to an authority, whether it be the SEC or the local police or whomever, is really outside the scope of my background and knowledge. But this is not as simple as it may appear. If it's a normal middle, lower level employee, then certainly it stays within the organization. Then management decides where to take it. But if it's senior management, if you're, for example, auditing Enron and everybody's kind of involved at the top, then it's pointless to try to resolve it, right? So that's the distinction. So. The audit provides reasonable assurance that the financial statements are free of material errors and fraud. Okay, yeah, so we're focused on finding things that are material. So that includes both errors and fraud, right? So it doesn't mean we're going to find everything. It doesn't, in particularly, if there's collusion involved and people are smart about covering things up, oftentimes those go undetected. So the objective of the auditor, right? So this is kind of a recap of this section. Obtain reasonable assurance of financial statements free from material misstatements, and then give an opinion, right? And then report that to the appropriate board of directors and shareholders. So responsibilities, material misstatements. We have to bring professional skepticism, right? And we'll talk about what professional skepticism is. And we have to distinguish between errors and fraud. Okay, so, all right. So auditors' responsibility to consider laws and regulation. Auditor suspects inquire of management, consults clients, counsel, or specialists, consider accumulating evidence. Auditor knows, consider the effect on the financial statement, consider effect on relationship with management, communicate with audit committee or equivalent. Okay, so if you suspect it, that's quite different than knowing it. So typically, as I mentioned, if it's lower level or middle management, then you're going to try to keep that in house, and even talking to the client's law firm is probably fine, or general counsel. You may want to help accumulate some evidence just to kind of point as to why you're concerned. But if then I think you have to, there's some things that have to go on. First of all, is it significant impact on the financial statement? Then if it is, then that external people, investors and creditors and others are going to have to know about this. So you certainly have to consider the effect on your relationship with management, but who do you communicate it to? So if they have an audit committee that is independent and not involved, then then that would be appropriate to go there and report your information without actually involving the CEO or the CFO and others. And then it would be their responsibility. But if they don't have an audit committee, or if you feel as though the board of directors might be involved with something like this, then you have to consult an attorney and consider going external with it. But again, I would work through somebody who has knowledge of the laws in this area. So not just go off on your own, because it's a very touchy area, this whole, as you could easily imagine. So let's talk about classifying transaction account balances into cycle and segmenting the audit. So that's where we're going to pick up on Wednesday. So at this point, what I want to do is go back to where we are. So right now, we have covered through chapter 6, and I've asked you to do a quiz on chapters 3 and 4. Next week, I'm going to have you do a quiz on chapters 5 and 6. And then next week will be a shorter week. So we'll finish up on chapter 6. So once we're done with chapter 6, I'll post the quiz for chapters 5 and 6, and then we'll get into chapter 7 as well. All right. So thank you for being here today. And I hope you all have a nice long weekend.
Thank you, Professor.
Thank you.
All right.
Thank you.